What if every country on Earth charged exactly 25% tax? The economic model breaks in less than 18 months. In 2024, a research team at the IMF ran the most controversial tax simulation in modern history. They asked one simple question: what happens if every single country on Earth, all 195 of them, simultaneously adopts a flat 25% tax on individuals and corporations? The number is not random. 25% is the global statutory average for corporate tax according to the OECD as of 2024, and it sits inside the historical comfort zone for personal income tax in most developed economies. The simulation was meant to be a sanity check on the OECD Pillar 2 minimum tax framework. What it actually produced was 14 distinct shockwaves that would reshape the global economy in roughly 18 months. France, Belgium, and Denmark would see government revenue collapse by between 18 and 32%. Monaco, the United Arab Emirates, and the Cayman Islands would gain tax revenue, but lose virtually all financial services activity inside 3 years. Ireland's corporate tax base, currently 25% of total receipts, would shrink by half overnight. The United States Treasury would actually gain revenue by roughly $480 billion annually, despite the federal rate dropping from 37 to 25. And the highest-paid 1% of workers worldwide would relocate out of high-tax countries at 4 times the historical rate. The simulation was so destabilizing that the IMF declined to publish the full paper, and only fragments leaked through academic conferences in 2025. This video reconstructs what the model actually showed: who wins, who loses, and why a flat 25% global tax is mathematically impossible to enforce, even when it looks like the fairest deal on paper. The simulation premise rests on 3 fixed assumptions and 1 critical variable. Assumption 1. Every country adopts a flat 25% rate on personal income above the local poverty line, with no brackets, no deductions, no capital gains carve-outs. Assumption 2. Every country adopts a flat 25% corporate tax with full base alignment, meaning no deductions for interest, royalties, transfer pricing, or research and development beyond a 5% innovation credit. Assumption 3. All double taxation treaties are renegotiated to use the source of income standard, meaning income is taxed where it is earned, not where the recipient lives. The critical variable is enforcement. The model assumes 90% baseline compliance, meaning 10% of all global income still flows through hidden channels, the same baseline the IMF uses for its current shadow economy estimates. Why 25%? Because the global statutory average corporate tax in 2024 sits at exactly 23.45%. Personal income tax averages 24.8% across the OECD. 25 is the round number where every developed economy lands within plus or minus 5 percentage points of its current rate. It is the only flat rate that does not trigger automatic political revolt in a major economy from day one. The IMF chose it deliberately as the least disruptive starting point. The simulation then runs over 18 months and tracks revenue, employment, capital flows, and sovereign credit ratings across 47 representative countries. The output is a heat map of winners and losers that nobody at the IMF wanted to publish. The high-tax countries collapse first, and the collapse is not subtle. France, with a current top personal rate of 45% and a corporate rate of 25.8%, sees personal tax receipts fall by 28% inside 12 months. The reason is mechanical. The top 10% of French earners contribute 71% of personal income tax revenue. When their effective rate drops from 45 to 25, the headline rate cut multiplied by their concentration produces a revenue gap of 73 billion euros per year. France's deficit, already at 5.5% of GDP in 2024, expands to 8.9% inside the first simulation year and triggers an automatic European Commission excessive deficit procedure. Belgium, with a top rate of 50% and the highest tax-to-GDP ratio in Europe, sees revenue fall by 32%. Belgium has the highest concentration of high-income workers in EU institutions and pharmaceutical multinationals. When their effective rate drops by half, Brussels loses 19 billion euros, more than the entire annual budget of the city region. Denmark, with a top rate of 55.9%, falls 24%. The Danish welfare state, which spends 30.4% of GDP on social programs, has no surplus capacity to absorb the shortfall. The model projects Denmark would need to cut $8.7 billion from public services in year one alone. Sweden falls 22%, Germany falls 19%, the Netherlands falls 17%. All 6 high-tax core European countries enter automatic deficit reduction mode, which means a synchronized austerity recession that the European Central Bank cannot offset. The IMF model projects EU GDP would contract by 2.1% in year 2 of the simulation as a direct second-order effect. The tax havens are the second pressure point, and the dynamics are completely counterintuitive. Monaco, with a current 0% personal income tax and 25% corporate tax on French source income only, would gain personal tax revenue for the first time in 156 years. The simulation projects 1.3 billion euros in new personal receipts. But that is the small story. The big story is that Monaco's entire economic model, built on offering tax-free residency to high-net-worth individuals, evaporates inside 18 months. The model projects 71% of Monaco's 12,400 high-net-worth residents would relocate to remaining low-tax jurisdictions, primarily one of 7 alternative regimes that survive in the simulation. Monaco's GDP, 95% of which is downstream of high-net-worth consumption and finance, would contract 38%. The United Arab Emirates is harder hit. The UAE adopted 9% corporate tax in 2023, which generates roughly $4 billion annually. Hiking to 25% would generate $14 billion. But the UAE's free zones, which house 30% of global maritime insurance and 45% of the world's gold trade, would see 60% of activity relocate to Singapore and Hong Kong. The Cayman Islands, with no personal or corporate tax at all, would gain roughly $2 billion in new revenue, but lose its entire $4.7 trillion offshore fund industry. The simulation projects the Cayman financial services sector, currently 60% of local GDP, would shrink to 8% inside 3 years. Bermuda, the British Virgin Islands, Bahamas, and Vanuatu follow identical patterns. The tax havens get richer in tax receipts and poorer in everything else. Corporate flight is the third pressure point, and it is the most economically violent. Ireland's economy has been built since 2003 on a 12.5% corporate tax rate, recently revised to 15% under Pillar 2. Corporate tax already represents 25% of Irish total tax receipts, the highest concentration in the OECD. In the simulation, Ireland's headline rate jumps to 25%, and 4 of the largest American technology companies, Apple, Microsoft, Meta, and Google, immediately announce intra-corporate restructuring to move their European intellectual property holdings out. The IMF model projects Ireland would lose 11.2 billion euros in corporate tax receipts inside 24 months and 47,000 high-paying jobs in Dublin. Luxembourg, with current effective corporate rates of roughly 18% on holding companies, sees 38% of its banking sector relocate. Singapore, currently at 17%, sees 22% of its regional headquarters move to Vietnam, Malaysia, and India, where enforcement of the 25% standard is realistically projected at 60 to 70%. The Netherlands sees its tax treaty network advantage evaporate, and the Dutch government loses an estimated 6.4 billion in royalty conduit revenue. Switzerland, with its cantonal tax flexibility, sees the canton of Zug specifically lose 30% of its corporate base. The simulation also models a counter-effect. The United States gains revenue between $410 and $480 billion per year because the federal corporate rate is currently 21% and the personal top rate is 37%. A 25% flat actually represents an effective tax cut for most U.S. households below the 95th percentile of income, while raising the corporate rate by 4 percentage points in a way that finally captures the offshored profits American multinationals have parked abroad for 4 decades. The U.S. is the unexpected winner of the entire simulation. The winners and losers split is sharper than any tax expert predicted. On the citizen side, the winners are concentrated in 4 specific groups. First, middle-class American workers earning between $60,000 and $250,000 per year see their effective federal rate drop from roughly 22 to 25% to a flat 25%, but with no payroll tax interaction. The net effect is roughly $1,200 in additional take-home for the median household. Second, citizens of historically high-tax European countries see their personal burdens fall by 15 to 30 percentage points. A French household earning 120,000 euros pays 18,000 euros less per year. Third, gig workers and self-employed contractors worldwide gain because the source of income standard collapses the patchwork of nexus rules they currently navigate. Fourth, retirees holding diversified equity portfolios benefit from the simplification of capital gains treatment. The losers fall into 3 hard groups. First, the bottom 30% of earners in welfare states like Denmark, Sweden, and the Netherlands lose access to public services as government revenue contracts. Second, the highest paid 0.1% of workers globally lose their domicile arbitrage advantage. The historical 4 times relocation rate for ultra-high net worth individuals is, according to the simulation, the relocation pattern that fully unwinds inside 18 months. Third, the workforce of small and medium-sized economies that depend on financial services hubs, primarily the 1.2 million people employed in Cayman, BVI, Luxembourg, Liechtenstein, Andorra, Monaco, Guernsey, and Jersey, face mass unemployment. The simulation projects 38% of those jobs disappear within 3 years. The reason a flat 25% global tax cannot actually exist is game theory, and the IMF model demonstrates it in 4 stages. Stage 1. Any country can defect from the agreement at 0 short-term cost. If France adopts 25% and Spain stays at 30%, every high-net-worth Frenchman moves to Spain, but if Spain stays at 30%, all of Spain's high-net-worth citizens move to France. The Nash equilibrium of the game is for every country to defect at the same time, which means the agreement is never signed in the first place. Stage 2. The countries that benefit most, the United States in particular, have no incentive to enforce against defectors. The U.S. gains $410 to $480 billion per year regardless of whether smaller jurisdictions comply, so it will never spend political capital to discipline Ireland or Luxembourg into compliance. Stage 3. Tax havens have lower transition costs than enforcement bodies. Monaco can lose 71% of its residents and still survive on tourism and real estate. The Cayman Islands can switch to a tourism finance hybrid in 5 years. The OECD, the IMF, and the EU all face higher political costs for being seen as sovereignty violators than for tolerating noncompliance. Stage 4. The exact economic model that the simulation projects, an 18-month synchronized contraction across high-tax countries, is itself the political reason no high-tax country would sign in the first place. The simulation creates the precondition that prevents itself from existing. This is the essential paradox the IMF researchers ran into. The fairest tax regime mathematically possible is the one regime that game theory makes politically impossible, and the IMF declined to publish for exactly that reason. The closest real-world parallel is OECD Pillar 2, the global minimum corporate tax of 15% that 138 countries signed in 2021 and that began phased implementation in 2024. Pillar 2 is not a flat 25%. It is a soft floor at 15% that lets countries keep their existing rates as long as effective taxation never falls below 15% on a country-by-country basis. The mechanism is the income inclusion rule, which lets the headquarters country top up tax shortfalls created by subsidiaries in low-tax jurisdictions. If Apple Ireland pays 4% effective tax in Dublin, the United States can collect the difference up to 15%. The OECD projects Pillar 2 will generate between $155 and $192 billion in additional global corporate tax receipts annually by 2026. The actual 2024 take was $41 billion, well below forecast, because 47 countries delayed implementation by at least 1 year in 12 countries, including Singapore, Hong Kong, and Switzerland, carved out major exemptions. The 25% simulation is what Pillar 2 would look like with both the rate doubled and full enforcement turned on. The IMF model is essentially a stress test for what happens if the next iteration, Pillar 3, ever attempts a true flat global rate. The answer the simulation delivers is that it produces $480 billion for the US Treasury, collapses 6 European economies inside 18 months, and ends 4 specific industries in the Caribbean, Channel Islands, and the Gulf. That is not a workable tax policy. It is a financial nuclear weapon, and the IMF, by declining to publish, has effectively confirmed that the only safe place for the model is on a hard drive nobody is going to read. If global tax policy fascinates you, subscribe for more. Every week, we break down one country, one loophole, or one real workaround the mainstream channels miss. Hit the bell so you don't miss the next one. We'll see you in the next video.